You are listening to Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elconin. We're joined by Adam Sarhan. He's the founder and CEO of Sarhan Capital. Adam, thank you so much for joining us this morning.
It's my pleasure.
So you mentioned right before we got on the show that you're seeing global markets trading like penny stocks. Please, I would love for you to elaborate on this.
Sure. When you look at the global markets as far as the asset classes over the last 12 to 18 months, what we've noticed, and we've been telling our clients and has told the media several times, that one by one, it's almost been like a series of dominoes that have somewhat have fallen, where you're starting to see heightened volatility, but not just heightened volatility, followed by very severe downtrend across several asset classes. So, for example, it began with commodities. Gold, silver, crude oil are all in bear markets. And that's not just, you can go copper, you can go look at the grains, soybeans, wheat, corn, cocoa, sugar, coffee. The list goes on and on and on. And these are multi-year bear markets. And what that tells us, we like to say that the market is speaking, are you listening? And one of the big things that we do is our job is to interpret what we see happening and then make intelligent decisions. So when you see for multi-years now, for the last several years, commodities and almost all the commodity markets are in bear markets, that tells you that demand is waning across the globe. So global demand has been a problem for a long time. We're now beginning to see that over the last few weeks. It really crescendo or reach not a tipping point, but become more mainstream with slowing growth in China and an extreme volatility we've seen in Chinese stock markets and our stock markets. But really, if you peel back the Chinese onion, if you will, the real concern there isn't so much that China's economy is slowing down. It's that the global economy is slowing down with central banks being very, very accommodative. The U.S. has rates of zero. ECB is printing with negative rates as well. Bank of Japan easing. Almost every major central bank in the world has some form of easy money. The global economy is slowing down, and that's why China's economy is really hurting, because they're an export-based economy. So if the people around the world aren't buying their goods, they legitimately have a problem, no matter what Beijing does to stimulate their markets. And that's really the underlying concern.
So how should investors approach this market right now? I mean, it's obviously a global issue in the way that, each of these different economies are interacting each other. What can we as the individual investor do?
Sure. Yeah, it's a few things. Number one, if you look at the way that the bearish dominoes have been falling over the last 6 to 12 months, is that you saw the big sell-off in commodities, and then you saw massive volatility. In the last few months, crude oil is my favorite example. It fell 60% in the fourth quarter of 14 and the first quarter of 15, and then it bottomed at $42. Then it rallied after falling 60%. It rallied about 45, 46% up until the May-June high. And then the last 10 weeks, it rolled over and it fell 37%. And then in the last week and a half, you had the largest gain. It rallied 29% in like 5 trading days. And then it was followed by the biggest decline yesterday in 7 months, and it fell about 10%. So you have daily swings in crude oil that are equivalent to manic moves in a lightly thin over-the-counter traded penny stock. And that's not healthy. And then it's not just crude. Look at the Dow. Last week with the massive sell-off, followed by, people call it Black Monday. I'm calling it Gray Monday because it wasn't as bad as the 87 crash, but it was pretty darn bad. But you just see massive moves. I mean, you had the largest single day, the weakest open on record. The Dow was down over 1,000 points, 1089 in the first 5 minutes. And then it rallied over 900 points on that Monday, which was the largest single day rally in history. And then every single day, Monday, Tuesday, Wednesday, and Thursday of last week, you saw record moves, intraday moves, up and down. And that type of volatility typically occurs during bearish phases, not bullish phases. And on your show for the last few months, we've highlighted important support in the S&P right near 2040. And that broke 2 Thursdays ago. So from our standpoint, we're operating with the fact that this global bear market started with commodities, it spilled over to currencies, because you also see massive, just wild swings in major currencies across the globe, and that's not healthy. And then it's now spilling over, what we've seen over the last few weeks, spill over to equities.
So you think we're finally seeing the end of this, 5-year bull market we've been in?
Yeah, we're in a 6.5 year bull market, but again, discounting. March of '09 up until March of
Mm-hmm.
16 was a 6 year mark, and now we're about halfway through that. So if you go look at historical highs or prior bull markets, the one thing in common is every bull market in history, no matter what asset class you look at, but specifically with stocks, has a definitive beginning and an end.
Oh,
So we're six and a
absolutely.
half years into this bull market. That's the bear sign. Is eventually the bull market's going to end. It's a matter of when it's going to end, not if it's going to end. Now, it broke below 2040. From our standpoint, for all intents and purposes, we're operating with the notion that we are in a new downtrend. We're in correction territory right now. Whether this turns into a bear market or not is still yet to be determined. But from our standpoint, we moved the cash before that Monday crash, and we're very happy to be on the sidelines and or not looking to buy anything right now because we're safe and we sidestepped it without any damage. And that's been a really, really big strength because now we've got the preservation of not just the physical capital, but more importantly, the mental capital. And that allows us to be patient and wait and let the market, let some more time pass, let some more price come out. And if you look back at other big sell-offs, they move sideways for a little bit, and then they end up either going up or resolving themselves down. So the next area of support we're watching is last Monday's low of in the S&P 500, the Nasdaq, and the Russell. So if last week's lows are taken out, we'd have to expect another leg lower to follow. If not, we expect a sideways action to continue. Let the moving averages catch up a little bit. Let the market digest this big sell-off, and let the Fed meeting come and go. We'll see what happens tomorrow with the jobs, or sorry, on Friday with the jobs report, and then we could go from there.
So, do you have a heavy cash position right now then?
Yes, absolutely.
And you said you pulled out the Thursday before last Monday.
Well, we began selling and moved the cash Thursday, and then Monday was a big crash. Thursday was the day that the S&P fell and broke below 2040, which was our level that we spoke about time and time again on your
Mm-hmm.
show and in
Mm-hmm.
writings and everywhere. And that Thursday was the 20th, and then the 21st we sold out, and then by Monday we're 100% in cash. And then that big negative open, it was not pretty. So for all intents and purposes, if you look back at the market, this was a slow moving, a train wreck kind of a thing where if you were paying attention, you could see it one by one. Several areas of the market topped out. Then you started seeing leadership narrow, which we discussed on your show. And then you began seeing fewer and fewer stocks hitting new highs. Concurrently, more and more stocks were hitting new lows. The major averages were moving sideways, but there just was virtually no leadership. And then one by one, important areas of the market that were holding the market up, the generals, if you will, began falling and falling hard. And there was nothing else really replacing it. And then once the biotechs and the financials broke, that was it. The S&P, the market, the major indices just couldn't. They got too top heavy, and then boom, all the selling started. And then once those levels were broken on Thursday the 20th, if you can go back and look, I mean, it's right on the. You can go to our site or any of the reports, and a lot of the stuff is for free, so you could see it. It was a year, almost an 8 month trading range, and when it broke below the bottom of that trading range in cash and S&P was 2040. It's time to get out of the way.
What, if anything, would make you recommit money to the market right now?
A few things would have to happen. Number one, we have to get this technical damage needs to be repaired. Number two, we want some clarity from the Fed and other central banks with respect to what they're going to do. And then number three, we really need to see a new round of leadership emerge. And that takes time. It's not overnight. So the bullish side of the argument for the bulls is that yes, it's 6.5 year bull market and all that fun stuff, but the S&P's PE ratio is still in the mid-teens. So you're not overvalued by a fundamental or valuation standpoint. Also, when you go back and look at history, we haven't seen a bull market end with rates at zero. That doesn't mean it can't end with rates at zero. It just means it hasn't happened just yet. So that's the bullish side of the equation, where the valuations aren't stretched, and also you have the Fed still with rates at zero. But the Fed's beginning to tighten, and the market forecasts going forward to 6 to 12 months. And if you look at the major indices and you look at commodities and currencies and just global markets, the markets are forecasting a recession. And I wrote that 2 weeks ago or 3 weeks ago on our free reports. And if the government, fiscal policy, and monetary policy don't adjust real quickly, it's almost inevitable, and we're starting to see that already. Look at Canada; they're in a recession. They just announced yesterday, and Australia is going to follow, and Russia's in a recession, and a lot of these commodity-heavy countries are already in recession territory because of the fact that these commodities that they're relying on are trading like penny stocks, and they legitimately are plunging. They're in bear markets. The GDP of a country like Canada, for example, and I was just up there a few weeks ago, and it's a beautiful place, and I love it. But you have a situation of economics, numbers don't lie. When you have a situation where oil's trading at $100 a barrel last year, and now you based your numbers on that in your forecast, now all of a sudden it's at 35 or 40 or even 45, that's a big haircut.
When you say new leadership, do you mean new leadership in the market or new leadership politically in the White House?
I would say more specifically in the market, because we've seen the market rally with Democrats, we've seen the market rally with Republicans, we've seen the market rally with everything in between. So for me, I'm very, very agnostic when it comes to external factors. All I care about is price action in the major averages for stocks, and then price action for on a global macro standpoint. What are the capital markets telling us? I like to say capital flows to wherever it finds the best ROI. And there's times where emotions take over, and there's times where, fear and greed drive the markets, and that's the one constant throughout history. It's human nature. It never changes. If you walk into a crowded theater and yell fire, you're going to get the same exact reaction no matter where you are. And the same thing with the market. So there's certain recurring behavioral tendencies that market participants tend to do, and you see that with extreme pessimism or extreme optimism and et cetera, et cetera. But what I would like to see for stocks to say, hey, listen, this bottomed, would be to make sure that last week's lows aren't breached, number one. Number two, let the market sit and move sideways for the next few weeks, if not the next few months. Digest those moves, and then have a nice area of resistance form, and then break out above resistance. And in the meantime, have leadership reemerge. Look at Netflix. I mean, you have some stocks that are acting okay now, but leadership is virtually non-existent. And when you have maybe 5 to 10 stocks that you can count on one hand, or possibly two, that are considered leaders that look good technically and fundamentally, that's a problem for the market.
Do you have any? Well, I want to take it in two directions. You mentioned that all of these markets and economies across the globe, Canada, Australia, are heading into recession if they're not already there. If that's the case, how can interest rates go up?
That's a great question, and the reality is that there's been a massive disconnect between Main Street and Wall Street, and it's occurred for the last 5 or 6 years. Rates have been at zero. The stock market, look, even with all this damage, you're down double 10% from an all-time high. You would think that Main Street is on fire and ramping, and you would think that the economy is growing leaps and bounds and things are great, but they're not. I was in the supermarket the other night, actually the Monday night that the market crashed. I was talking to a buddy of mine on the phone, and she's like, are you talking about stocks? Didn't something happen today on Wall Street? And this is the cashier, the lady checking me out of the cashier at a grocery store. And I said, yeah, we're talking about the market. And she was, oh, that's all, they're printing money. This is a quote from the cashier. That's all monopoly money. They're trying to tell us that things are fine and dandy. All they're doing is helping the rich, and the rest of us suffer. And I said, really, what do
Wow.
you, of course, I'm curious, right? So I said, really, what do you think? And then she's like, people are telling me to leave the country. We're in for a bigger decline or a bigger mess than 2008. Like a depression's coming. And this is mainstream America. Like, this is just literally a lady at the cash register checking me out at the grocery
Yeah.
store because I needed milk, and that was it. So that's what the word is on the street, pardon the pun. But you have a massive distrust going on across the country, and not just the country, but the globe. And for a lot of reasons. Main Street has not participated in this massive reflation of the quantitative easing that we've seen over the last few years, even though asset prices stock markets specifically have gone up. Everything else has been out the window. And that's interest rates also, and that's currencies and commodities.
Are you planning on leaving the country, Adam?
No, not at all.
That's a great story, though, and I mean a great
Not at all.
demonstration of just
My
just
daughter's three and
Main
a half years
Street.
old, and we went to Disney. My wife was with her in Aquatica yesterday in SeaWorld, and we were at Disney World last weekend. And we're very, very optimistic on our country in the future, and very, very optimistic about things getting better. There's a lot. It's very easy to fall into a negative spiral and fall into that whole victim scenario and say the end of the world and things are blah blah blah. But it's very important, especially from an investing standpoint, is to filter out all the noise and focus on the facts and then make intelligent decisions. And it's up to you. I mean, look, there's infinite amount of opportunity in front of us each and every day in the market, and that's what I love about it, and that's what attracts me to it. There are no rules except, what we say is that you've got to be legal, moral, and ethical. Outside of that, you're free to buy and sell anything anytime you want. So it's on you, the onus is on you, the investor, to see those opportunities and then react accordingly. And there's no one stopping you but yourself. And if you don't know how to do it, then you're free to acquire that knowledge. And we help people do that time and time again. And that's it. So, literally, you've got infinite opportunities in front of you each and every day. And even with a bear market's not an inherently bad thing. If you're out of the way and you're in cash, guess what? After every bull market, there's a new bull. After every bear market, there's a massive new bull market that's born. So we're very, very optimistic.
Okay, I feel like I can sleep soundly at night now after that. Thank you. But so,
My
let's
pleasure.
take a look at some specific names. U.S. equities. You mentioned there aren't that many leaders, but what does stick out to you as a leader in the market right now?
So one of the strongest stocks in the market is Skechers right now. That's SKX. Here's a
Really?
extremely strong stock. Yeah, I mean you can look at it. This is a textbook example of what a leading stock should act like. Even with all the selling, it hasn't even broken its 50-day moving average. It briefly broke below there, but that was that Monday, and then it kind of got right back up above there. Volumes dried up. The stock looks very, very strong. And when you have a chance, you can go back and study and look at the last year or so, even 2 years. Textbook example, big breakaway gap on very, very heavy volume, followed by another big breakaway gap, heavy, heavy volume, et cetera, et cetera.
Wow. Okay.
And with all the selling, the stock it refuses to fall.
What about
So
something?
a stock that doesn't, sure, sorry, go ahead.
Oh, no, no, keep going, please.
I was just going to say a stock that doesn't fall, a great way to separate strength from weakness in a weak environment. Like right now, the major indices are all in correction territory. They're under pressure, et cetera, et cetera. The best thing that we do during this time frame is we isolate strength. And in our weekend report, you can go and find leadingstocks.com and sign up for it. We literally highlight the strongest stocks because if the market does decide to rally from here, you've got them front and center for you. And then we're long and short, so we give short ideas as well. If the market decides to roll over, we'll need some more time for that. There'll be a lot of short setups as well. But another leading stock on the upside would be Buffalo Wild Wings. BWLD is the symbol. And look at this one. You have a big breakaway gap after earnings back at the end of July. And the stock just sat quietly, formed a little handle up here, BWLD. And if you didn't know that the market would crash last week and, the end of the world and, dot, 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 the stock looks great. It's only a few
Anything?
percentage points below an all-time high, and the stock looks very, very strong.
Yeah,
That's what we look
absolutely.
for leadership.
We've got just like 1 minute left with you, Adam. Are you looking for any shorts to put your cash to work?
Absolutely. What we do when we look for shorts is we don't want to get involved in no man's land. So meaning the major indices, if you look at last week's low and you look at last week's high, interestingly enough, the volatility was so wide that right now we expect the sideways action to continue for the near term. If either one of those areas are broken, last week's high to the upside or last week's low to the downside, then we start looking for some shorts. But in a bear market, if this is the beginning of a new downtrend, which is very, very possible, and we're operating with the notion that it is a new downtrend for now, as long as the S&P stays below 2040. You look to short strength instead of short weakness. So just like in an uptrend, you want to buy the dips, you want to buy weakness. In down markets, you want to sell strength, not just sell weakness.
Hey, great advice from Adam Sarhan. He's the founder and CEO of Sarhan Capital. Adam, thank you for joining us this morning. We always love to get your take on the markets, just both macro and US. We will have to bring you on again very soon.
My pleasure. Thank you.